Before you write that check, you actually owe capital gains on your sub-2 sale right now. Hi, I'm Sherry Aylen, CPA and tax advisor, and I help my clients pay little to no tax using my zero tax blueprint. Someone in a Facebook real estate group last week posted they sold their property subject to. The buyer took over the mortgage and the seller's equity comes as a balloon in 3 years. Their tax person told them they owe a huge tax bill right now. That answer might not be wrong, but if that's all they were told, it's dangerously incomplete. Today, I'm going to show you exactly what this looks like with real numbers and 2 different payout structures so you know exactly what to expect before you close a deal like this. In a normal sale, the buyer gets a new mortgage and yours gets paid off at closing. You get your money, the IRS gets its cut, and you're done. In a subject to sale, the buyer takes title, but your existing mortgage stays in place. You don't get paid off at closing, and you get your equity later, maybe as a balloon payment. So the question becomes, when do you owe tax on money you haven't received yet? Well, the IRS has a specific answer for this. It's called the installment sale method. The rule is simple. You recognize gain as payments come in. You don't owe tax on money you haven't received. But there are 2 things that don't wait, and we'll get there. And before we talk about installment sales, timing, or gross profit ratios, there's one question that should have been asked before anything else. Was this the buyer or seller's primary residence? Because if it was, the seller lived in it for at least 2 of the last 5 years, they may not owe any capital gains tax at all. Under Section 121 of the tax code, a single filer can exclude up to $250,000 of gain from the sale of a primary residence. A married couple filing jointly gets $500,000. So, if our seller is married, living in this house as their primary home, and their total gain is under $500,000, the answer to, do I owe capital gains, might simply be no, 0. Not now, not at the balloon, not ever. That one question completely changes the conversation. And if their tax person didn't ask it, that's where the analysis broke down. Now, in our case study, this is a rental property. So the Section 121 exclusion doesn't apply. And we work through the full installment sale. But keep that question in your back pocket because it's the first thing to check on for any sub-2 sale. Here are our numbers. Maria bought a rental 5 years ago for $225,000. She put 20% down, so a $180,000 mortgage at 4% on a 30-year term. The monthly payment, $859. Now, here's something that surprises people. After 5 years of payments on a 4% mortgage, her loan balance is $162,806. She's only paid down $17,000. Almost every early payment goes to interest, and that is just how a 30-year mortgage works. Now, her property is worth $300,000. Her equity, the difference between the value and the loan balance, is $137,194. That's what the buyer owes her. Now, the tax piece. Because this was a rental, Maria took depreciation every year, $6,545 annually, for a total of $32,727 over 5 years. Those deductions reduced her taxable income while she held the property, but they also reduced her basis. So her adjusted basis isn't $225,000, it's $192,273. The total gain is $107,727, and it splits 2 ways. The $32,727 is depreciation recapture, and that is taxed at ordinary income rates at up to 25%. The remaining is the long-term capital gain, taxed at the preferential rate of 0, 15, or 20%, depending on her income. Now, just a small disclaimer here, that basis that she has and the gain that she has, we're not taking into consideration for these calculations any costs of the sale, like realtor fees and etc. So now we're going to look at 2 scenarios. Scenario A, where the buyer receives their equity as a pure balloon at the end of year 3, and scenario B, where they're getting some payments against their equity over those 3 years, with the balance being a balloon at the end of those 3 years. So in scenario A, the buyer pays the full $137,194 as a lump sum at the end of year 3, nothing in between. Year 1, Maria files Form 6252 to elect the installment method and reports the sale. Cash received is 0. Gain recognized is 0. The tax on the sale is 0. Year 2, same thing, 0 gain, 0 tax. Year 3, the balloon lands. 137,194 hits her account. She applies the 78.52% gross profit ratio, which is the total gain divided by the contract price. She recognizes the 107,727 of gain all at once. First, 32,727 is recapture, tax it up to 25%. The remaining 75,000 is a capital gain at 15%. The estimated tax bill, approximately $19,432. And one more thing, this note has to carry interest or above the IRS applicable federal rate, which right now is 4.13%. That's about $5,666 per year in ordinary interest income reported on Schedule B each year. This is separate from the gain. Now, scenario B, same deal, but the buyer makes monthly payments calculated on a 30-year amortization at 4.13%, with a balance due as a balloon at the end of year 3. Their monthly payment comes out to be $665 a month. But here's, again, what almost nobody thinks about. On a $137,000 balance at 4.13%, amortized over 30 years, almost all of that $665 is interest. After 2 full years of payments, Maria has only received $4,823 in principal. The balloon in year 3 is still $132,371. So what does the installment sale look like? Year 1, $7,984 in payments. $5,622 is interest, which is ordinary income on Schedule B. Only $2,362 is principal. You apply the 78.52% gross profit ratio. $1,855 of gain is recognized. All of it goes first towards recapture, and your tax is about $464. Year 2, $7,984 in payments again, but now the interest is slightly lower, $5,522, because the balance has dropped by $2,362 after year 1's principal payments. $2,461 in principal means $1,933 of gain recognized. Your tax on that is about $483. Now, year 3, the balloon comes due. But remember, interest has been accruing on that $132,371 balance all year. At 4.13%, that's another $5,467 in interest. So the buyer actually pays $137,838 to close out the note, $132,371 in principal, plus $5,467 in interest. Maria reports that $5,467 as ordinary income on Schedule B. The $103,940 of gain recognized on the principal triggers estimated tax of approximately $18,485. The total tax on the gain across all 3 years, approximately $19,432. Total interest income across all 3 years, $16,611. Pretty much the same as scenario A. That's the most important thing in this video. The total tax bill is essentially identical in both scenarios. The installment sale method is not a tax reduction strategy. It's a tax timing strategy. You control when the gain is recognized, not how much. And in the 30-year note scenario, 95% of the tax still lands in year 3 with the balloon anyway, because 30-year amortization barely touches the principal. You're getting cash flow in years 1 and 2, but the tax clock doesn't really start ticking until the balloon. Now, back to that Facebook post. The very first question should have been, was this a primary residence? If yes, and they met the 2 out of 5 year use test, the Section 121 exclusion may have wiped out the entire gain. That conversation would have ended right there. If it's a rental or investment property, then the complete answer requires separating recapture from capital gain, calculating the gross profit ratio, making sure the note carries at least the applicable federal rate, and planning for the balloon the year it arrives. This is not a plug-and-play tax return. Form 6252 gets filed every year there's an outstanding balance, and the elections made in year 1 affect everything that follows. If you're doing sub-2 deals, buying or selling, make sure whoever is on your return understands how installment sales work in the creative finance context. For more information about installment sales, watch my prior video on that topic. And if this helped you think about your deal differently, share it with someone in your community who needs to hear it. I will see you in the next one.